Today, we're going to be talking to Daniel Lacalle, who's one of the best communicators and macroeconomists out there. So hopefully this will be a good conversation. Everybody that's here, my name is Michael Guyad, publisher of the Lead Lag Report. Joining me, Daniel Lacalle, who's got a number of books, has a fantastic way of looking at the macro economy, and I think has a lot to talk about here. So, Daniel, I know we've done this before, but for those that are not familiar with who you are, your background, just talk about everything you've done so far.
Thank you so much for having me. My name is Daniel Lacalle. I'm a chief economist at Tressis, which is a broker-dealer and asset manager with above $7 billion of assets under management. I'm also the author of 4 books. The first one, Life in the Financial Markets. Second one, The Energy World is Flat. The third one, Escape from the Central Bank Trap. And finally, the last one, Freedom or Equality. I'm also a professor of macroeconomics and global economy, and quite prolific in Twitter and different social media. So very happy to be here with all of you.
Diego Perilla helped write the Energy World is Flat, right? I believe.
Absolutely, we wrote the book together in both the Spanish and the international version, and it was a great experience. Diego's a tremendous guy, and the book was because it was quite a shock when we published it, because it was a time in which we predicted a prolonged period of energy disinflation that would create afterwards a period of energy inflation, which is precisely where we are today.
Yeah, I had Diego on a space a couple months back. Have it on the YouTube channel as well. And he was the crowd absolutely loved the way he was framing things in terms of anti-bubbles, which maybe we can also touch on a bit. But okay, so I put a poll out yesterday because I thought it was just interesting to see what the mindset was, and the poll was, who's to blame the most for inflation, at least in the States, right? And I said, is it Biden or Powell? And it's pretty much close to 50-50. Now, we are taught that inflation is a monetary phenomenon, but it seems like most people are not quite sure who's to blame on the monetary side. Right. So talk through the dynamics of how you view what actually causes inflation and who is ultimately responsible for it.
But it's a very good answer what your readers put together, because if you think about it, ultimately it's always a monetary phenomenon. But the reason why it becomes evident in the overall price index is fundamentally because of a massive increase in government spending. So probably the people that voted were pretty much right about the fact that an enormous level of money printing that went to massive government spending in current spending generated this level of inflation. Inflation is always not the increase in prices, but the weakening or the reduction in the purchasing power of the currency. And prices don't go up, all of them at the same time, in an environment in which the quantity of money is the same. You may have one price go up, you may have the price of oil going up, but you don't have everything else going up with it unless there is more money in the system. And when in the middle of a pandemic lockdown, the government and the Federal Reserve decide jointly to massively increase the amount of money in circulation, the central bank, and the government use it to send checks to citizens, to increase current spending, etc. Ultimately, what they're creating are the foundations of a massive inflationary spike that, once demand comes back because the lockdown is finished, generates this process that first they called temporary, and then they see as persistent. So the situation with inflation is therefore always something that you have to blame on the central bank and the government, because the central bank can increase money supply, but if the government doesn't massively increase spending and well above the demand of money, then that amount of money that the central bank has created may go either to financial assets and therefore create inflation in financial assets, which is what we saw in the period in which we were told that there was no inflation, or it simply floats as excess liquidity in the system, in the banking system. That is, when newly created money comes in the form of quantitative easing. But the only way in which it can create massive inflation, the way that it's happened in the United States or the Eurozone, is by increasing enormously money supply, putting it to work as government spending in current spending, and increasing the price of almost every good and service available to citizens. So that is the problem of inflation, and the reason why it's so difficult to reduce, because the deficit this year in the United States is going to be another 6% of GDP. So it's going to be monetized one way or another, no?
And it's important to also make it clear that this is not just sort of a U.S. Phenomenon, right? This is just
Yeah,
the way central banks in general work. So that kind of goes to a discussion around Europe, because you mentioned weakening in the purchasing power of the currency. Now,
yeah.
a lot of noise has been made about dollar strength, but that's largely because most of these dollar indices are very heavily weighted towards the euro, and the euro has been decimated relative to the dollar. Talk about, because again, you're sitting in Spain, I believe. Talk about what's the state of Europe currently, and in the context of all this talk about stagflation in the U.S., do you believe it's a similar dynamic in Europe, or is it different given the proximity to Russia, Ukraine, and
Hmm.
demographics? So let's talk about that a bit.
It's different and similar at the same time. It is different for those two very important reasons that you mentioned: demographics. The European Union, the Eurozone are economic areas in which the aging of the population is quite significant, and at the same time, population is not growing. So demographics compared to the United States, very different, with very different, obviously, consumption dynamics. And the second, obviously, is the secondary effect of the Ukraine war, which is very, very relevant in the eurozone. Germany, Spain, France, Italy. Italy is has already seen its GDP contract in the first quarter. Germany has narrowly missed recession. So the eurozone, on top of it, is coming into this process of massive weakening of the growth in the economy uh, in a very bad moment, because the recovery was already very poor. At least in the United States, you had end of 2020, beginning of 2021, with quite substantial levels of growth and very strong levels of employment growth. However, in the Eurozone, it's been pretty much disappointing throughout the entire process. The Eurozone basically reached the peak of the recovery in September 2020. And since then, it's been in a process of basically disappointing and weakening macroeconomic figures. So, you mentioned before inflation. Inflation is hitting the eurozone a lot harder as well, because at least in the United States, wage growth is about 4%, which mitigates the effect of inflation. In the Eurozone, wage growth, both in nominal and real terms, is pretty much inexistent. No? So those
Why
are
is that? So that's interesting. So why is there such a difference in the wage appreciation between the U.S. and Europe?
that is a very interesting process, and it's difficult to explain, because in the United States, you probably, or everyone remembers, that when the pandemic started, unemployment rocketed to record highs. But when the economy reopened, it shot down very, very quickly. the response to the pandemic that the Eurozone implemented was different. So unemployment didn't rise as much. In fact, it even rose less than the levels of 2008 because a lot of furlough jobs were implemented, which are subsidized employment schemes by which you keep your job even though you're not working and even though you're not earning the same salary, not even half of it. No, so the furlough jobs kept unemployment relatively lower in the European Union throughout the period of the lockdown. However, when the recovery came, the furlough jobs remained. In fact, in numerous countries, Spain, Italy, Greece, there are still hundreds of thousands of people with these schemes of subsidized employment. And the recovery was not as robust, obviously, also because the slack in the economy is larger than in the United States. And having a larger slack in the economy with high inflation is a very, very troublesome situation for central banks and for policymakers, because it's virtually impossible for them to make decisions that will be strong enough and decisive enough to combat inflation, because the level of utilization of industrial production of the labor force in the level of tightness of the labor market are completely different from the United States.
We often hear people in the U.S. say that the Fed is stuck, right? They're never going to
Mm,
be able to fully unwind the balance sheet. But I'm curious if you think the ECB is more stuck.
yeah. I think that is one of the problems that many in many conversations with U.S. friends, they repeat that message, which is ultimately pretty right, no? But at the end of the day, the U.S. dollar is the world's reserve currency. It's used in 59% of the transactions globally. No, the euro is used in 20%, which is pretty good, but not even nearly enough to be considered a world reserve currency. So the problem for the ECB is the following: if it starts hiking rates the way that the Federal Reserve has done, the or is announcing to do, what the European Central Bank faces is a situation in which states throughout the Eurozone that have that do not want to reduce deficit spending, that certainly do not want to implement structural reforms because they perceive that that would be detrimental to their popularity with voters, are going to have a very, very tough time in terms of financing their debt. On the other hand, if they don't take decisive action on hiking rates and reducing the balance sheet, then the inflationary pressures are going to have a much larger impact and a longer term impact than, for example, in the United States, as we mentioned before. So for the ECB, it's a very stuck in a between a rock and a hard place situation, catch 22 situation of deciding between the solvency of states that are financing themselves at rates that are massively lower than what the reality of their solvency and liquidity would suggest, and the and inflationary concerns, which are pretty significant, but ultimately as well very different between countries. Spain has 8.4% inflation. France has 5.5. It's very high, but but the differences are significant. So the problem for the ECB, which is not dissimilar to the Fed's, but without the luxury of having the world reserve currency, is that it is in a much worse situation than the Federal Reserve, the Bank of England, or any other developed economy central bank, because of the completely deranged disparity between the yields at which Eurozone states are financing themselves and the reality of what investors would pay for those bonds if the central bank was not purchasing them.
Although, in fairness, in the States, you can make a similar analogy when it comes to municipal bonds and different finances across different
Hmm.
parts of the country, right? So I think that's an interesting dynamic. And really, what you're talking about is, they have to risk the return of the 2011 sovereign debt crisis when the pigs were all the rage, right, and yields were blowing out. So, how does the ECB try to navigate that, right? Because maybe you're right. Maybe it's a function of the it's goes back to the point that it's partially also the government spending side. But how can the ECB even thread that needle?
It is extremely difficult. But let me come back to the point of the differences between the United States and the Eurozone. It is not the same to have municipal or uh, different local authority bonds in the United States trading at negative real yields than to have Greece, Spain, Italy, and Portugal yielding negative nominal and real in some of their bonds. And the reason for it is that the euro is the only currency in the world, and certainly the only reserve currency in the world that has redenomination risk. But there is always the Damocles spade of somebody deciding to break the euro area. No, so quite a significant difference. The other one, of course, is that relative to the levels of inflation um, and the appreciation of the currency, both those municipal bonds in the United States and local authority bonds in the United States relative to Greece, Spain, or Portugal, or Italy even, um, remain significantly less monstrously expensive, if that makes any sense, in the sense that they're all hugely expensive and widely separated from the reality of the solvency, but in the case of Europe, much worse. So how does the ECB navigate this? Well, Bernanke used to say this idea that central bank policy is 80% communication and 20% action. And in the ECB, they have bought that message rigorously. And they certainly believe that they will help reduce inflationary pressures by saying that they are going to do things that they will probably not do, and at the same time bake the cake and eat it, as they say in the United Kingdom now, is be able to continue to allow states to finance themselves at incredibly low yields while reducing inflationary pressures. I think it's impossible, to be fairly honest. But what the ECB should do, in my opinion, is the following. The ECB the central bank's balance sheet is more than double the United States one in terms of weight to GDP. The Central Bank of Europe, the European Central Bank, is about 70% of the GDP of the Eurozone, its balance sheet. No? So what it should do is first to stop purchasing everything that is a newly issued bond from sovereign issuers. This would at least allow them to test the waters of the demand that exists from investors in the secondary market. The second thing that they should do is that once they are happy with the level of yields that those bonds are trading at, then they would at the same time need to stop refinancing those bonds that mature, which is what they are not going to do. So basically, what they should really start doing is not thinking so much about rate hikes, because real yields are rising anyhow. They should be really thinking about reducing the balance sheet of the central bank. Unfortunately, what the ECB is doing is looking at the Bank of Japan and thinking, we really like that. We'd rather have an environment in which economic growth is poor and debt is high, but we manage yields and the yield curve to a certain level and everything sort of remains relatively stable, than to rock the boat. However, they're ignoring the reality of saving and import of foreign exchange reserves of the Japanese economy relative to the European one.
Okay, so that's there's a couple of directions that we can go with that. So let's talk about that with Japan yield curve control and the yen, because I've made that point before that what's happening with the yen may end up being, with hindsight, the most important dynamic this year to pay attention to. Um, Talk about how you're viewing Japan's response to this yield spike, and if you think actually it may be something that other countries themselves may do, because if they can successfully pull off yield curve control without decimating the yen further, uh, that might be somewhat of an answer to what's going on in the bond market.
Yeah, I think that you're absolutely right. The depreciation of the yen has surprised everyone that has always seen the yen as a stable currency that will work as a sort of defensive asset in a weakening scenario. And the reason for it is comes from communication of the Bank of Japan and obviously action as well. Kuroda said two things that are impossible if they're done together. The first thing is that the Bank of Japan is going to commit unlimited, I quote, unlimited amounts of purchases of bonds, and at the same time that he is going to pledge to maintain the yen stability. You cannot do both things at the same time. And you cannot do both things at the same time in an environment in which there is some inflation. So why? Because the thing that keeps the yen strong and stable in an environment of massive yen printing is the fact that Japan as an economy is a massive generator of foreign exchange savings. Its companies are selling globally and bringing dollars to the Japanese economy. And at the same time, the Japanese citizens are huge savers. Okay. So yield control is something that you can sort of pull through with uh, a certain level of success and for a limited period of time, as long as there is no inflationary pressures, as there are no inflationary pressures. The problem is that Japan is facing rising imports. At the same time, weakening exports because of the impact of inflation in other countries, and therefore the the foundation of the strength of the yen, which is its massive import of and bringing home massive levels of foreign exchange is under threat. So I don't think that they can pull a yield curve control in an environment in which the supply of bonds has to inevitably go far beyond pension funds in Japan because of the size of it, and second, because of the weakening, uh, fragile structure of the strength of the yen, which is fundamentally predicated on the massive or savings in foreign exchange of both the corporates and in local currency of citizens.
You know what's interesting is that for years, everyone said and was convinced that the only answer to all of this government debt, whether it's with Japan, the US, or the Eurozone, is high inflation. You got to inflate
Hmm.
away debt, right? I think people forgot, though, the mechanism with which you do that. You ultimately have to do that inflating away of the debt with higher wages to tax, so that the nominal amount of added dollars or currency, right, to pay off the debt is higher than the existing debt. And of course, that the debt doesn't increase. So we have this interesting environment where everyone is afraid of inflation, including governments, because of concerns around societal discontent. But that was supposed to be the only way out of all of these liabilities.
Yes, the problem when you try to central plan the economy is that it never works. No, this is the idea that you're going to generate enough inflation to deflate the debt, while at the same time keep a certain level of consumption and manufacturing growth, because because wages are going to rise above that level of inflation, and at the same time margins are not going to be under pressure. Think about this. It's playing the Wizard of Oz, to be fairly honest. Is thinking that everything is going to be great just because you say so, and just because somebody has written an Excel spreadsheet in which it seems that it's going to work, but it cannot work, because the problem is ultimately that money creation is never neutral. It disproportionately benefits the first recipient of money, which is government, and it disproportionately negatively affects the last recipients of money, which are real salaries and deposit savings. Guess what? The idea that you're going to create an inflationary spiral that is going to be small enough to allow wages to grow enough so that real wages do not fall and corporate margins remain stable, therefore you can tax away part of that increase in spending coming from inflation, it makes no sense. And it makes no sense because it's impossible. No, if that was possible, Argentina would be the most solvent country in the world, and it isn't. And the reality is that uh, the idea that inflation was going to help reduce debt could only come from from an additional point, which would be that once inflation kicked in, government deficit spending would stop. And therefore, then you have sort of a double Keynesian positive. No, on the one hand, uh, debt deflates, and on the other hand, government starts to save and get the benefits for the next growth period, and therefore, and the negatives of inflation would disappear very quickly. The problem is that that is impossible now, when what governments, both in the United States, in the Eurozone, have done is to massively increase current spending that becomes mandatory, and that and deficit spending is not even reduced in this environment. Therefore, the consumption, government consumption of newly created money does not decelerate, but it accelerates, and it accelerates at the expense of real wages and deposit savings. So it monstrously destroys the middle class.
I'm glad you say that, because it kind of goes to this point that I keep referencing, that oddly enough, even though the answer to paying off government debt is higher taxes, the problem is, at least in the U.S., and I'm sure it's a similar dynamic all across the world, every single new dime of taxes raised ultimately goes to justification for further spending, not to pay off prior debt, right? Because the
Hmm.
incentive is to offer more. So you
Hmm.
end up having higher taxes and actually more debt as a result, because the interest expense is still building on what you already borrowed.
Certainly. And the other problem is that is the way that the things are calculated in the political discourse, is that they say, oh, we're going to raise taxes to this segment of the population. We're going to raise 30 billion of revenues. And with those 30 billion of revenues, we're going to spend 30 billion of subsidies or whatever entitlements every year. Now, the calculation starts flawed, no, by saying that you're going to raise 30 billion one year, and that those 30 billion are going to remain exactly the same forever, and that there's never going to be either a crisis, a recession, lower revenues, whatever. That's the first part. The second part is that the calculation of the 30 billion of revenues is completely over optimistic, yet the calculation of the spending is probably underestimated. So, so you increase taxes that are volatile, that are cyclical, that obviously generate negative impacts on different other parts of the economy and can generate significant backlashes, uh, in order to spend more on things that become structural and that do not change on a year-to-year basis. So when the next administration comes in and wants to review the budget, they find that about 70% of the budget is mandatory and that they cannot do anything about it. And that the other 30%, there are a number of programs that simply have already been spent before the budget is presented. So the idea that you're going to raise taxes and that there's going to be fiscal consolidation through revenue measures sounds appealing, but it's simply flawed. And it's simply flawed because in the moment that there is a recession, the amount of mandatory spending sends the deficit through the roof, and it accumulates. So uh, they will continue with the idea that taxing it out is the solution, but it is not. The idea that deficits are caused by lack of revenues is simply ridiculous economics. Deficits are always caused by a problem of excessive spending, because you should not spend based on the idea that you are going to make more money next year. You should spend based on your ability to manage your own budget the way that a family or a business does. And obviously, the message that states are different than families or businesses because they can always tax away their problems is debunked by the reality is that it doesn't happen.
Let's go to the idea of the dollar being the reserve currency for a moment, because it looks like Russia is trying to find ways of challenging that
Yeah.
with pricing oil in ruble. Talk through to the audience, because I think a lot of people are hearing this stuff on the periphery, but they don't really understand sort of what's happening on the back end. Talk through what's happening with Russia and how it's trying to counter some of these sanctions from the U.S.
Okay. The Russia knows that the best way to counter sanctions from the US is to try to make the European Union uh, get on its knees in terms of the amount of fossil fuels that it purchases and how they purchase them. The policy of making the customers that purchase fossil fuels buy it in rubles is not designed to reduce the reserve currency status of the United States dollar or to do anything to the United States dollar, because Russia knows that its trading with the United States is very small. It's designed to make the euro weaker. So by that, you would make Germany, the Netherlands, France, the big customers of Russia in terms of purchasing natural gas, etc., sell euros in order to buy rubles. What would the central bank of Russia achieve with that? First, that there would be an incremental demand for rubles in an environment in which, with capital controls, they are trying to manage the collapse of the ruble. The second one, obviously, is to weaken the euro. It's a double strategy, no? Not just try to get some demand for rubles globally, and obviously at an exchange rate that is intervened, which makes absolutely no sense. And the second one is to weaken the euro. So by forcing their customers that purchase natural gas, who cannot basically just go out and purchase it from somebody else to buy it in rubles, they try to achieve both things. The problem with the Russian ruble, in any case, has very little to do with the current environment. The Russian ruble has been depreciating against the dollar for a very large number of years, despite the fact that the governor of the Central Bank of Russia, who's a very, very smart woman, by the way, has been increasing reserves of gold, reducing exposure to the dollar, increasing exposure to the euro, managing a situation that they envisioned would happen, which is what we're seeing today. Now, obviously, what everybody looks at their screens and sees is that the ruble has recovered its pre-Ukraine crisis level. However, that is a completely fake ruble exchange rate. There is no Russian citizen and no Russian business that can exchange rubles today at that exchange rate for euros or for dollars for whatever they want to do with them. The difference, because there are massive capital controls and because the government forces you to use a certain exchange rate. So the reality is that there is no real demand for rubles. The exchange rate that we see in our screen is similar to the exchange rate that we see of the, I don't know, the North Korean currency or the Cuban currency. You don't even think about it because it's completely unreal. And in the secondary market and in the underground economy, people who are trying to get euros or dollars in exchange for rubles have to pay about a 70 to 90% more or worse exchange rate for the ruble than what you see in their screens. No? So in any case, a very difficult situation because we look at it from one side. No? We look at it and we say, well, the European Union depends on Russia to purchase natural gas. Therefore, Russia has the upper hand and can force the European Union to buy in rubles. Well, you have to see the other side, which is that Gazprom does rely on the European Union to sell its natural gas. You cannot sell those molecules to China. You cannot send them anywhere else quickly and cheaply, considering the reality of transport, of pipelines, etc. So it's a double-edged sword here. Right now, what we're seeing is one side of it, which is Russia forcing some of the European customers to purchase their gas in rubles. What we're not seeing is the other, is that if there is an oil and gas embargo from the European Union against Russia, it is not that easy to offset it with exports to China and to the rest of Asia because of all of the logistical and obviously pipeline problems that entails. So. So a tough one, a tough call, to be fairly honest. But I think that ultimately the position of Russia is not as strong as some headlines would suggest, and the position of the European Union is not as strong either. The European Union cannot go out and implement a full oil and gas embargo tomorrow. It has to be, they have to take quite a bit of time. So it's not as black or white as some headlines would suggest.
Talk through China's response to this, again, going back to what seems to be this kind of renewed currency war or currency movement that's happening. How is China, you think, going to respond to this as it relates to the yuan?
Well, obviously, China has been maintaining the yuan at an artificially strong level because it was aiming at gathering higher level of support for the yuan globally, and with constant devaluations and fixing and capital controls, the yuan is a very strange currency. You have a country that is about 20% of the GDP of the world. Is going to at least is one of the largest economies in the world, and whose currency is only used in 2.8% of global transactions, the yuan. No? So China has been maintaining the yuan relatively strong in order to try to gather more confidence, both internally and externally, and gradually, with that strength, be able to at least diminish a little bit or reduce the level of capital controls and sort of try to open the currency. But it's an impossible situation because you cannot have the two things at the same time. So I think that what China is doing is a directed and central planned uh, management of the depreciation of the yuan in order to make it as small and spread out as possible so that the problem of inflation doesn't go through the roof, and at the same time that it doesn't create a 2015 2016 type of problem. So very, very difficult again, because the point, I come back to it, be it with Russia, be it with the United States, be it with the Eurozone, be it with China, doesn't matter how big you are, is that you cannot central plan monetary and monetary policy so that everything works perfectly to the design of the political party or the political entity that designs it. Monetary policy will always generate very, very significant imbalances. And in this particular case, the central planned devaluation of the yuan is likely to lead to an even weaker utilization of the yuan globally in transactions. History doesn't repeat itself, but it rhymes. Uh, I heard that in a movie some time ago, but I don't think that it's the same situation that Keynesians tended to see, that that a global pandemic followed by resource war, etc. There are numerous reasons for them. Let's start with why. This is the first pandemic in history in which we have not seen any level of real scarcity. We have seen some inflation, but we haven't seen scarcity. We have not had to fight to get bread or to get water or to get clothing. This is also the first pandemic in which what you have seen is the appreciation globally of the world reserve currency. Usually, a pandemic led to a massive collapse of savings and a massive collapse in the price or the value of gold reserves, etc. The other one is war. No, you mentioned is that even if we had scarcity, which we don't, but even if we had scarcity in the vast majority of developed economies, the level of debt and the level of and the way that we have been educated, etc., would make it impossible to reach a level of confrontation the way that the person that made the question may be thinking about. For example, if tomorrow Russia uh, fully invades Ukraine, does anybody really think that French, Spanish, Italian, German citizens are going to go to war? No, they won't. So, so no, it's very, very different in many, many levels. And the biggest driver of why it's not going to be the same is how insanely indebted everyone is, including those that would benefit at some point from a war. The way in which you benefit from a war, or what you used to benefit from a war, was by getting a country that saves a lot to support countries that are at war and then lend them money and make a lot of money. But that is not the case. We owe too much to everybody, including and not one of the most indebted economies in the world, which is China. Well,
Well,
yeah,
you can buy Daniel's books, by the way. Okay,
you can. That is certainly one answer. The other answer is to follow Michael. Michael, that I find it sometimes surprising that so many people think that it's impossible to make a little bit of money or to get a little bit of your savings, maintaining the purchasing power of your savings and maintaining your level of wealth when there's such an incredible level of wealth in information out there to invest in things that can be really attractive. But the best way not to lose money in this environment is to start by never following the three worst, this is in one of my books, the three worst sentences in economy. First, it has a good dividend. Second, it's a good company. Third, fundamentals haven't changed. Hmm? Those three sentences, every time you hear them as a recommendation, either for a stock or for a stock in particular, will lead you to lose money. The other one is to think, is when you see the next wave of government plans, is when you read anywhere, this time will be different, never bet for it to be different, because it will not be different. Every time that you, like in the person that spoke before was Spanish, no? Every time that you hear in Spain that you're going to increase massively spending, increase massively debt, increase massively taxes, and the economy will be stronger, do not invest in that, because it will never happen. In Spain, in France, in Germany, it doesn't matter. When you hear from the other day, the IMF director said that she was surprised, at how quickly debt had ballooned after the monster stimulus packages of the pandemic. Oh, what a surprise! Things are never different. They're always the same. You spend too much, you get into too much debt. You raise too much taxes, you get less revenues. You put you try to central plan the currency valuation. The currency valuation collapses. It's always the same. Well, let's start from the end. Having a large percentage of gold reserves in fiat currency helps, but it doesn't solve anything. Why? Because if you look at the country that had the highest percentage of gold reserves out of total, those gold reserves, anyhow, were less than 1.5% of its money supply. So it doesn't even start to compute between money supply and gold reserves. Obviously, you may say, well, then the solution is for those gold reserves to increase massively in value, or for the currency to depreciate massively and meet somewhere in the middle. Both would lead that country to a massive crisis. The first question is even more important, is you don't create an alternative financial system with countries or currencies in which there are capital controls and in which institutions are not independent. It is impossible. You would not accept it. You, the person that made the question, or I, would not accept that currency. The reason why the US dollar became the world reserve currency is not because they were very large and they were in a very strong position, but because they had independent and transparent institutions that guaranteed investor security and legal security. I come back to the point. If you calculate the percentage of gold reserves that the United States had, and when Bretton Woods was implemented, it continued. It massively went. I don't know. It's not even 0.8% of its money supply globally, and it is the world reserve currency. You don't the amount of gold that you own doesn't create a world reserve currency. The reason why you don't so you cannot create a world reserve currency or an alternative financial system in with countries in which the systems institutions are completely dependent of the government. It is impossible. You Today you would not accept your savings to be in rubles or in yuan. And so China and Russia can try to circumvent, can try to get a little bit of ways, but ultimately you cannot become a world reserve currency or an alternative to the dollar when the alternative is worse than the dollar. Remember that.
No.
The only way in which you, and this is why cryptocurrencies appeared, and somebody else asked about Bitcoin. Cryptocurrencies appeared as an alternative because there is no alternative to the US dollar when everybody is playing the Federal Reserve without doing the only thing that the Federal Reserve does that no other central bank does, which is to pay attention to secondary demand globally of your currency. That the European Central Bank doesn't do it, the PBOC doesn't do it, the Russian Central Bank doesn't do it either.
Let's go back to the name of the space, Daniel, global recession. So a lot of people seem to think, well, it's going to be next year. I happen to think that we may already be in one because inflation is probably higher than whatever is reported. Assuming that we have this kind of global synchronized downturn, how long do you think this cycle could last? What makes it maybe different than other cycles? Going back to that prior question about if things repeat, is this sort of a rhyme, or is this sort of an approximate rhyme? Let's call it like that.
I think that you're right. I think that we are already in a real recession. Why are we already in a real recession? If GDP growth is only 3.8% with a 20% of GDP stimulus plan, that is a recession. That is very, very evident. If on top of that, the growth of the economy is as weak as it is, real productivity growth is not rising, and real wages are not rising, while at the same time prices are rising much faster than what CPI indicates, because I think that everybody can understand that CPI is a basket in which statistical bodies always tweak in order to make it more favorable to government intentions. So I think that first we're already in something that is very similar to a global recession. What I think as well is that what the reality of the past 4 decades has shown us is that recessions are, and that cycles are shorter and more abrupt each time. So before, we tended to believe that recessions used to last 5 years, or that crisis would last 3 to 4 years, etc. But they're much shorter now. So I think that the longer the inflationary spiral remains with productivity, nominal and real wages, and investment and economic growth so weak, the longer that it lasts, the shorter it will be in terms of that it will end abruptly with a deflationary spiral.
Which then would result in treasuries going back to their historical behavior, risk-off asset. And I agree with you that you end up having sort of another deflation pulse coming. That's when you get that convexity in treasuries. It's just not clear when that occurs.
That is the problem. The problem is, when does it occur? This is a very interesting thing about April 2022. This is the first time in only since 2008 in which equities, the S&P 500 and treasuries, have fallen in tandem. This is quite extraordinary. At the same time, this is the first time, at least since we wrote The Energy World is Flat, in which you see commodities rising or very, very strong, and commodity producing countries with their currency being weaker relative to the dollar. Except for the Brazilian real, which is simply bouncing from an atrocious 4-year period. So those elements show that what investors are is extremely puzzled about the situation, because everybody allegedly bought into the idea that inflation was going to be transitory. Everybody bought into the idea that growth would be significantly higher than the trend for 2022, 2023. And when there's so much money exposed to that bet, which includes, on the other hand, a very modest monetary policy um, tapering, then the level of unwinding of the trade might take longer than many of us would have expected. But in my opinion, the longer that inflation keeps rising at these levels, or at least it stays as elevated as it is, the quicker we will see a deflationary spiral once destruction of demand kicks in.
I think that's a good place to end the space. Listen, everybody that's been here, certainly make sure you follow Daniel, check his books out. Daniel, I always appreciate talking with you. I'll make this an edited podcast in about a week or two. I'm also doing another space at noon with Leland Miller of China Beige Book, which will be interesting because we'll talk about everything going on internally in China. But Daniel, you're the man. I really appreciate all the time here.
Thank you so much. It's been a true pleasure. And thank you for the questions.
Thank you, everybody. Cheers.